Hi guys, I'm Manu and welcome to another episode of Sweet Money. Look, I don't care how old you are, how much money you have or don't have, how much experience you have, or what kind of business you're starting. The bottom line is that you have made a very gutsy move. It's very scary, but it's very exciting at the same time. You are now developing a wolf mentality. You are now going into beast mode. And Brother Manu is super proud of you. As you go down this journey, a lot of your critiques will plant these seeds of doubt in your mind. What I want you to do is ignore those Debbie Downers and keep trudging along that path you've chosen for yourself. And unknowingly and even knowingly, you will skip several steps. You might be busy, might be cash flow issues, or just the fear of the unknown. And some of those steps that you'll skip is before you start your business, you might not get a business plan. You might not have a contingency plan. This is the part of the show where you give me some SLC. Subscribe, like, and comment. In Canada, if you start a business and your annual revenue is $30,000, you do not have to register a business. You don't have to charge HST. You don't need a business number. However, if a child opens up a lemonade stand on their parents' lawn and they sell lemonade without charging HST, it's acceptable and it looks cute. But you, as an adult, if you open up a business and you're not charging HST and you don't have a business number, that's cray-cray. And according to my 13-year-old daughter, cray-cray means crazy. For the purpose of this video, I want to delve into 4 types of corporations: a not-for-profit, NFP, a passive corporation, a PSC, which is a professional service corporation, and then a CCPC, which is a Canadian controlled private corporation. And then at the very end, I want to talk about when do we need a corporation and when can we work with it as a sole proprietor or a partnership. A not-for-profit. Canada Small Business Services defines a not-for-profit as
a business organization that provides products or services to improve or benefit a community. These organizations are usually concerned with generating enough revenue to provide support to those chosen communities.
Now, if you want to start a soccer club or if you want to start a single parent support group, you will then have to start a not-for-profit corporation. Now, the reason why you need this corporation is, number one, you want to protect yourself from any lawsuit. With a not-for-profit, you can now get commercial liability. So you don't want people coming after you. All you're trying to do is help someone. Now, it's not your fault that someone goes cray-cray. Number two, you will have to charge HST. All goods and services in Canada require that you charge HST, and this is no different. Number three, a not-for-profit does not pay any taxes. Now, if you're generating a profit from this not-for-profit, but you don't have a not-for-profit corporation, you will have to pay those taxes out of your pocket. Now, why would you want to pay taxes when it's not even necessary? In addition, in order to have a not-for-profit, you require 3 board of directors. If you do not have 3 board of directors, a corporate lawyer cannot legally open a not-for-profit for you. Now, you might be wondering, what's the difference between a not-for-profit and a charity? And the biggest difference is a charity can issue a donation slip, whereas a not-for-profit cannot issue a donation slip. A passive corporation is defined as follows. But before I get into the definition, I want you guys to be aware of something. A passive corporation can also reside in a PSC or a CCPC. So this gets a little convoluted, but for today's purpose, I just want you to understand the 4 types of corporations and what kind of activity takes place in each corporation.
At least 75% of the corporation's gross income is passive. That is, derived from investments or other sources not related to regular business operations. At least 50% of the company's assets are investments, which produce income from earned interest, dividends, or capital gains.
I'll tell you guys something. Indians love opening corporations. They wear it like a symbol of pride. It's a badge of honor. It's an achievement. I get calls every once in a while saying, hey, Manu, I just bought an investment property. Do I need a corporation? And I say, no, sorry, my friend, you do not need a corporation. They go silent. I can feel the disappointment in the silence. And they're thinking, oh, Manu's cray-cray. And I'm thinking, they're cray-cray. But the truth is somewhere in the middle. But listen, if you want to blow a few $1,000s getting a corporate lawyer to open up your corporation, then having me file your corporate returns, it's fine. It's your money. But my job is to help you and give you sound advice that's right for you and only you. Now, here's a fun fact for you guys. CPAs in Canada are not allowed to open corporations. There are some shady CPAs who provide this service. If you come across one of them, I want you to run for the mountains as fast as possible. So, the average working Canadian who ends up owning a couple investment properties, a bag full of stocks, does not need to put these assets in a corporation. I know it looks really cool to tell your friends you have a corporation, but please trust me, you don't need it. The tax rate is 50% on a passive corporation. Why would you want to pay that kind of money? Now, for all my entrepreneurs who have corporations, if you have cash sitting in a checking account accumulating 0% interest and your accountant says nothing about that, it's time for you to change your accountant. If you have investments sitting in your business earning even $1 of interest or dividend income, it's time for you to change your accountant. A PSC, Professional Service Corporation. Now, this branches off into two areas. The first example is you're an IT professional. You are subcontracted by the bank to work for them 40 hours a week. And the bank stipulates that as a contractor, you must have a corporation. They will pay you through the corporation. Then in this case, you have no choice. Now, because you only have one client who is the bank, you are not considered an active corporation. Therefore, you'll be taxed at 30%. Now, for the rest of us, the dentists, the physicians, lawyers, accountants, engineers, when they open up a corporation, such as myself, it's called a PSC, Professional Service Corporation, but we are not taxed at 30%. We are still eligible for the small business deduction, which is 12%. The reason for that is because we have an active business. We have multiple clients. We are not just serving one client, because technically that guy working for that bank is an employee. He's not really an entrepreneur. Now, I just want to say for that individual who has one client but owns a corporation, it is highly advisable you pull all the money out of your corporation and leave a profit of zero. Because like I said, the taxes are 30%, and you can do better things by pulling that money out, such as putting it in an RSP, making CPP contributions. Now, on the other hand, doctors and dentists, it's mandated they have to open up a PSC. Accountants and engineers, for instance, are not required to open a PSC. They can work as a sole proprietor or in a partnership. The main reason to have a corporation is to protect your assets. So the way it works is you have your corporation, and on top of your corporation, you have what we call a holdco. Now, in your holdco, you put all your assets, your building, any heavy, expensive equipment you have. And then in the unfortunate event of a lawsuit, your building, your equipment, any cash that you have cannot be touched. It's protected from the lawsuit. A third reason why we have a PSC is because non-licensed professionals are allowed to be shareholders in the corporation. So your spouse, your children can also be shareholders, which allows for income splitting, which allows for a tax break. However, recently, the government is starting to frown on this practice. But because we're coming up to an election year, because the government is not doing that well in the polls, they have kind of held back. A CCPC, when you open up a restaurant, a software company, a construction company, or a bicycle repair shop, and you live in Canada, means you have now opened what we call a CCPC, a Canadian-controlled private corporation. As an entrepreneur, you are not required to open a corporation. You can run a business as a sole proprietor or in a partnership. you get the same benefits that you get in a corporation, such as you can have commercial liability, you can run payroll, you can hire people, and you can also own assets such as buildings and other equipment. So you're probably wondering if to the outside world, having a corporation or not having a corporation makes no difference in how you run the business, then why would anyone open a corporation? Well, there's three reasons for that. Number one, as I told you earlier, you can protect your assets through a holdco. In a lawsuit, your assets sitting in the holdco are untouchable. Number two, the government might stipulate if you bid on their contracts that you have a corporation. And some companies also demand that you own a corporation in order to do business with them. Banks are a classic example, not only with individuals, but also with vendors that they deal with. It is mandatory that they have corporations. Number three, the most important reason when I feel a entrepreneur should transition from a sole proprietor to a corporation is when their profits start to exceed their salary expectations. For example, if you're earning a profit of $250,000, but you only need a salary of $150,000 to make ends meet, at that point in time, you transition to a corporation. Now that excess $100,000 sits in your corporation. But if you don't have a corporation, you then get taxed on your personal income tax on the full $250,000. Now, why would you want to pay 48% tax on $100,000 on money that you don't even need? You're better off leaving the money in the corporation, paying 12%, which is a small business tax rate. And then later on, as you're ready to retire, through estate planning, there are tools to help bring this money out by paying little to no taxes. And remember, it all starts with a simple conversation.